Yeah, probably in a minute we will start.
Sure. No worries. Do you want me to share slides as well in between, or broadly
Yeah,
we'll have a Q&A? That's perfectly fine.
yeah, I have allowed multiple sharing, so
Okay.
you can one or two few slides as you think important. You can
Sure.
please, yeah,
Sure.
can
No worries.
from your presentation. Hello, subscribers. Good morning. Before getting into the session, recently our subscriber base has crossed 60,000 mark, and I would like to thank all of you. We request to inform your relatives and friends about our channel and benefit from the insights that we bring to our subscribers. We have Mr. Dhaval Gada, fund manager from DSP Mutual Fund with us today. And Dhaval, welcome. Good morning.
Good morning. Thank you for the opportunity.
Yeah. Let me put few lines about you. Dhaval Gada has more than 13 years of investment experience across major market cycles. He is fund manager with the DSP Mutual Fund and is managing some of the prominent funds from the DSP stable, such as DSP FlexiCap Fund, DSP Equity and Bond Fund, and the DSP Dynamic Asset Allocation Fund. Prior to DSP, he has worked with the Sundaram Mutual Fund and Motilal Oswal Securities. He has a postgraduate diploma in finance from Wellinger Institute of Management. And to say about DSP Mutual Fund as a fund house, they have been here for a while now. And DSP Mutual Fund today manages more than 1,32,000 crores of assets across various categories. Out of that, if I have to differentiate, 90,000 crores is predominantly in equity, and about 42,000 crores is in debt. So one of the largest fund houses in India today. Welcome, Mr. Dhaval Gada. Thanks for taking time and joining us for today's session.
Thank you so much.
Yeah, and now you are having just to make that context. You are coming out with the NFO in the banking sector fund. Generally, I have seen fund houses whenever they come out with the new fund offers nowadays in the last few years, they usually find a very good logic, or they think that sector should go up from now on. So, or it is like a contrarian bet, so that the fund performance also looks better after a year or after 2 years. So when I saw your NFO, that's the question that arose in my mind. So overall, there is a broad thinking that market has peaked now. However, you are coming out with the NFO, and that too in banking and financial services sector. What is your view on banking and financial sector? What do you think? Whether it is currently undervalued, whatever. Just if you could share your thoughts to our subscribers, it will be helpful.
Sure. Thank you so much for having me here. And you've raised a very important question around timing of the fund. So generally we've tried in thematic funds specifically. We've tried to be very apt about our timing, our process in which we do our research, and based on that, if we feel that a particular theme needs to be pushed for investors to make money. That's what we've done in healthcare. That's what we've done in Tiger and several other funds. And we feel that the same situation is right now, present in the BFSI space. Although our sort of core of this NFO is that it is one of the themes that you should have significant exposure if you're bullish on India. And so it's a very structural story. But most of the times thematic funds get associated with timing, and so this is like that powerful combination there, where a structural story is available at very attractive valuation point, very attractive timing within the market cycle, and that's what we are trying to present to investors. And if I may just show one slide from our presentation, I hope you are able to see it. So basically, if you look at the right-hand side chart of the BFSI sector performance versus Nifty, Generally the perception is last few years it has not done well, and that is correct. It has underperformed in absolute terms by about 23 percentage points. But if you look at relative performance, it is even lower than where it was in the GFC period. So from a timing perspective, while markets can be range bound for a while, but from BFSI's perspective, from a timing perspective, it is very solid. And I sort of normally tell investors that this is hidden alpha, because if you look at 10-year rolling data of BFSI space, it has always outperformed Nifty. And even on a 7 and 10-year basis, there is a more than 90% rolling return is more than 12% in 90% of the cases. So that's the kind of wealth creation that this space has done. And the timing right now, we believe that there is we are nowhere close to the GFC environment, and from that perspective, we feel that this is a very a powerful time. In just absolute valuation terms, if I were to look at the absolute valuations, we are right now at long-term average of valuations. So markets may be slightly above average in terms of valuations, but BFSI, both banks and BFSI index, which is a broader index, both are at long-term average in terms of valuation. So the investor is coming in not paying anything more than what it has historically done on average basis. So that's why we feel that the timing is very powerful. In terms of basically the background of this thesis is we are having a very strong balance sheet cycle. Our economic growth is stable and likely to improve further. And in that context, BFSI is supposed to do well. And so there are fundamental triggers, and then there is a just a relative underperformance trigger, which is also there.
Yeah, I understand that you are saying that there is the sector as a whole right now is underperforming. If it is underperforming, there should be some reason. Why is it underperforming? Of late we are seeing even yesterday or day before yesterday, RBI came out with some guidelines for increasing risk weightage, etc. But why is it underperforming, and what will drive in the future?
Sure. So no, it's again a very fair question. So if you look at starting point of the when we entered into COVID, so till 2019, BFSI was doing extremely well. Post at the start of COVID, the chart that I showed you of relative underperformance, at the start of COVID, the positioning from both foreign and domestic investors was significant overweight into financials, and we had 2 years of very tough NPA cycle for the lenders because of COVID. Repayments was a problem, and both 2020 and 2021 we had a challenge in the sector. Although it started recovering in the fag end of CY21, calendar year 21, but just in general we had a tough 2 years. And in this period, if you go back and sort of look at history, 2021 was the period where investors wanted to play work from home or technology related themes, because they believe that COVID has really given a boost to this space. And so globally in India, tech did very well in CY21, calendar 21. And then again in 22, things again, out of home became again a sort of a theme. Consumers wanted to move out. So tech, the number of growth that people are expecting, growth rates started to taper off. Globally in India, tech started underperforming. Financials came back. In the meantime, balance sheets of financials improved. So financials came back. So if you look at CY22, financials actually did well. But they were not able to recover the lost ground of calendar year 20 and 21. Which even today we are not able to do. Part of the reason, if you were to deep dive, is one of the largest merger that happened, in the space, and that constitutes a large part of the index. So that's one reason why that particular stock has not gone anywhere, and that's one reason why the index doesn't look, very well placed. But if you were to again slice that and look at performance, it's actually, significantly better. And if you look at several NBFCs, several banks as well, they have done significantly better than Nifty as well. It's just that one or two names which were due to some corporate events, they've not been able to perform to that expectation. So, which is again one more point that we've always highlighted investors that this is a very diversified, very large sector, and needs a very specialist, to do this job, because there are NBFCs, there is banks, there is capital marketplace, there is fintech and other digital infrastructure companies. So, and you find opportunities. Like, for example, this year we saw some of the NBFCs, PSU NBFCs did extremely well in the infra lending space. We've seen how some of the exchanges and depositories have done. So a lot of opportunities has come in mid cap, small cap, some of the large caps, but mega caps have not done in this space. So that's where I would leave it. So to summarize, it's partly ownership and partly some corporate events. We are very hopeful that the corporate event that has happened probably in the next 12 to 18 months, it should be business as usual. And there will be, points where the sector will again come back in the mega cap space as well. So that's where I think there is very good opportunity in next 1-2 years for investors to make phenomenal alpha.
Okay, sure. Just to now speak from where you left, you mentioned that you will be covering not only banks, I mean, in this portfolio, but in banking and financial services portfolio, but as well fintech firms, as well as other firms. What are all the industries, industries in the sense, sub-segments of financial sector that you will be covering in the banking and financial services portfolio?
Sure. So I have a very interesting slide here. If you see, this is what has happened in BFSI space. This is a total BFSI universe. So if you are speaking in 2016, for example, we basically had 75% of our conversation would have been around banks, and balance 25% would have been around NBFCs, a very small proportion of capital markets, insurance. So this is where we were in 2016. Roll forward few years down the line, this is where our position is. So there is banks which is broadly there or thereabout, but NBFCs have expanded, the market cap of NBFCs have expanded, the market cap of insurance has expanded. There have been AMCs which have got listed, and then there is a small layer of fintech which has come in. So the universe has expanded significantly. So these are large pockets. On top of that, we see a lot of opportunities come up in some of the digital infrastructure space, in insurance, third-party administrator space, some digital DSAs and normally physical DSAs as well coming into space. Payment processes are likely to get listed in a year or 2 years. So the space is expanding. So I would say that there is lenders, which is banks and NBFCs. Then there is insurance company, capital markets, which is AMCs, brokers, wealth managers, platforms, distribution platforms. Then there is fintech, and then there is payments as a big space, which is likely to emerge, and plus some ancillaries of all these pockets that we just discussed. So that is the universe. And one point that we make in this is, if most investors tell us that we already have a large BFSI exposure, I say yes and no. Yes, you have in your diversified funds, BFSI is very large. But if you look at the underlying constituents of those funds, 70% in our assessment is about banks. So predominantly you are just focused on one part, but there is this big layer of opportunity which is small but growing. And investors should have exposure given our penetration in some of these opportunities that is there.
So approximately now, in the graph that you had shown, it's approximately 50-60% banks and the rest other. Am I right?
Correct. Yes, you're right. Out of 23% of total BFSI market cap, so BFSI constitute about 23% of market cap. On free float basis, it's north of 30%, but on market cap basis, about 23%. And banks is about 16 of 23. So you're right, around 60-65%. 60%.
Okay, and generally when we come to any sectoral fund, any investor comes to sectoral fund, hoping that it will give a superior return than a diversified fund. So, is it true here as well? Generally, are you expecting to deliver better returns than Nifty 50 or Sensex or a regular diversified fund?
That's the idea. That I believe that we can generate significantly better returns than Nifty. And as active managers, if we do a good job, it will be quite rewarding for investors. So here is one more a long-term chart of this index. The benchmark of this fund is the Financial Services TRI fund. We've taken from inception. It has delivered about 17.6% TRI returns. Nifty in the same period is about 14% TRI. So that's the excess alpha that this index itself has generated. And as active managers, if I'm able to beat this index by a few percentage points, then that's extra return for the investors that you can have. So what we have been saying is that this is a very challenging journey. So you have to be invested in the long term, but it's quite rewarding for investors from a return perspective. One more question that we get from investors is it really back-ended, or are the returns have already gone and we've seen the best period? So here is one more interesting data that we share to investors. On a 10-year rolling basis, this index has had 100% hit rate versus Nifty. So again, it tells you that if you've been invested in this index for a long term, 10 years, 15 years, you're likely to beat a Nifty by a decent margin. And as active manager, if I'm able to beat this index, you're likely to get even further alpha in your portfolio. So that's the broad expectation that we have.
Okay, sure. And generally, the thing is, when you earlier we covered also, you will be investing in banking stocks, and what are all the other subsegments you are going to add into this for BFSI sector?
Sure. So predominantly, the thought process is right now, given where we are in the environment, where we are in the economic environment, where we are in the rate cycle environment, we believe right now there is a reasonably good opportunity in the NBFC space. So that is one big differentiation we'll have in the fund structure compared to the benchmark. Which is more skewed towards banks. More than 70 odd % of the benchmark is in the bank space, but we will have less than 50%. That's based on the current prices, less than 50% in banks, and slightly more skewed towards NBFCs and other opportunities in the capital market and insurance space. So that's the opportunity that we are right now more interested compared to the banks. So it will have banks, it will have NBFCs, a few capital market plays, a few insurance play, and there is also an element of global that we have enabled in this fund. Although we in the initial period will be close to one odd stock at max in the first few months, and minimum can be zero as well. Again, depends on the price point and the India opportunity. And here our global play is going to be largely in the payments place, where we see there are some very solid businesses globally, which we may not get in India, and they are reasonably well growing, strong compounding stories. And if bought at right valuation, they can give you a reasonable alpha for the investors, and good exposure for the investor as well.
Okay. When you mentioned alpha, I have a question. Are the banking stocks, generally, there is a school of thought that, banking stocks, you borrow money and you lend generally. Of course, you are including financial services, lot of other things. So they say that, banking sector itself is more riskier.
Yeah.
So is it so? I mean, is it riskier than when compared with other industries?
Yes, it is more riskier. Riskier in the sense, I would say it has a higher beta than other some of the other sectors, maybe IT or for that matter FMCG or pharma. It would have higher beta, but at the same time it's more rewarding as well. So when the returns come, when the lending is good, the money rolled by some of these banks is phenomenal. And just to give one data point, if you look at the total profit pool in India and the contribution of BFSI, it's approximately 1/3 of profit pool comes from financial services. Almost, I would say, more than 80% of that comes from banks. So that's the dominance that this business, as a business model, lending has in India. and it's growing in double digit, equal or higher than nominal GDP growth. So that's the story. So yes, it is more volatile. It is cyclical to how the economy behaves. If there is a slowdown, there is likely to be NPA. But on the upside, when the economy is doing well, stable to improving environment, the earnings trajectory can really shoot up. And we've seen that in last few years. If you look at any of the banks in the last 3-4 years, despite COVID, the earnings revival has been quite strong, and they are at close to all-time high, if not at the best point, but close to all-time high in terms of return on equity. So again, that tells you that they come back very strongly.
Yeah. I do agree on that front. And the one more point you may add probably is somewhere I read that the debt to GDP ratio of Indian consumers is very low. The amount they borrow from banks, the percentage they borrow from banks as a population is less than China or any developed nation. And also, of course, we are on a growth path from per capita income shooting up from $2,000, $2,500 to $10,000. Probably banks will have a very good day. Banks are financial services as people come up. Yeah, good. That is that.
So here is the data that you. So we have this one slide in our presentation which talks about penetration.
Oh, very good. Okay.
And the point that you mentioned around household credit, which is what consumer credit as a percentage of GDP, which is basically saying how much is the credit penetration. So we are at about 37%, and where some of the other economies are much higher. So we basically, the point that I was trying to tell some of the investors was we are right now the 5th largest economy and likely to be 3rd largest in few years' time. And if you look at some of our nearby peers, we are significantly lower on credit penetration, both at a absolute including corporate and even at a retail level. And so that's this number would have been much lower about 10 years back. It has gradually improved over a period of time, and it is likely to improve even further, given the financialization of every consumer in this country, with the work that the government has done on various aspects, government and the regulator has done on various aspects, be it the public infrastructure that they've created on the GST side, on the credit bureau side, on the account aggregator side. All that helps investors, lenders to give money to consumers, and that's what is playing out. One interesting insight for the viewers is today bureaus have more than 47 crore individuals data on credit. Any lifetime they've taken a loan. The bureaus came in somewhere in 2008-9. So if from that point, whenever any individual has taken a loan, that data has been captured by the bureaus. And today 47 crore individuals data is there. I think our working age population is roughly about 100 crore. So that's the kind of penetration that we've reached in this space, and it's improving. Every year 10 odd percent of delta, more than 10% delta comes from new to credit customers. This is all because of the work that the government and the regulator and the other industry players have done. So that's what is happening, and I believe that credit penetration will continue improving as the economy progresses, as the per capita improves, and we'll see that play out in other spaces as well, outside of credit as well.
Okay. No, the Aadhaar and the Jan Dhan accounts and all those things, yes. Everything is given. And is there a different style of fund management? Nowadays fund managers are doing different styles, and someone is saying dynamic, and someone is saying I'm going to fundamental, or whatever it is. How you are going to manage this fund, when compared to your competitors?
Yeah, so my approach has been very bottom up all through in the last several years that I've been on the investment side of business. My approach has been completely bottom up, no attachment to any labels of quality, growth, value, momentum, completely bottom up. Just alpha focused has been my approach. The only threshold that I've kept is management quality has to be reasonably good. That if the company and the team makes money in the business, they proportionately share with the minority shareholders. So that's the only threshold, quality of management. But apart from that, completely open to alpha generating opportunities. So that's how it's been. No bias towards PSU, no bias towards private. No exclusion list. Broadly, wherever there is opportunity within this space, I've looked at those opportunity and captured them.
Okay, sir. And why should one consider investing in this NFO or any other banking and financial services sector fund at this point of time?
So I would say, from a timing perspective, we are at a very good juncture. From valuation perspective, from a growth perspective, we are very well placed going into next few years. One point we so far haven't discussed is, until 2020, a bulk of the credit growth used to come from retail because we did not see private capex or capex cycle in general come through, and we had lull for several years. So retail credit used to be the predominant growth driver, which meant that credit growth used to be high single digit, low double digit kind of growth. With capex coming back, we've seen growth come back to mid-teens kind of level, and now roughly half and half has been the contribution of retail and non-retail in the credit growth. So we believe that once this growth sustains and improves a little bit as the capex intensity picks up even further, so that will help earnings growth as well. Given that my top line growth is in mid-teens kind of level, so that's the broad expectation. We are entering into a strong earnings in the next 2-3 years, and valuations are reasonable, and balance sheet quality is extremely pristine at this point of time, and likely to remain so for another few years. So that's our broad expectation.
Okay. Now understood. And on a broader level, just if you say that these are the types of investors who should put money into banking and financial services fund or a sectoral fund, whom would you identify?
So I would say any long-term investor, more than 5 years horizon, should definitely consider BFSI, dedicated BFSI fund. That would be one set of investor that I would definitely urge to consider. The another set of fund investor who wants to be tactical about thematic opportunities, and he believes that he can time well. Here is one push from our side, that look at this opportunity from next a couple of years perspective, if not more, and you will likely generate superior alpha in this opportunity. That's our belief. That's how our traditional funds have also been positioned, overweight financials, with the view that we'll likely generate alpha in this space. So these are two broad set of investors we would urge to consider. Yeah.
Okay. So those who don't need money, generally at least 5 years. That's what we see.
Absolutely.
For long term, generally in a 5-year time horizon, this should generate more returns than the Nifty or a regular diversified fund.
Correct. Yeah, that would be our expectation.
Yeah, very good. And you are coming out with this NFO. When are you opening this NFO?
On Monday, 20th of November.
Okay.
It opens. Yeah.
And then it will remain open for 2 weeks?
2 weeks, yeah. 4th of December it closes, so it will remain open for 2 weeks. Yes.
Oh, okay, sure. Then I think that's all from my side. Probably let me check if there are some questions from subscribers who are watching right now. Probably if you can answer them as well, then probably
Absolutely.
we can.
More than happy. Yes.
Yeah. Give me a second. One question is there a passive Bank Nifty index fund similar to Nifty and Sensex? They are asking. You are now the current fund you are offering is actively managed.
Active managed fund, yes.
Do you have also a passively managed fund or ETF or something like that?
Yes, we do have a passive managed ETF. We've recently done that as well in the banking space and even in the private banking space. So yes, those products are available.
Okay. So one for PSUs and one for private bank, something like that, or
yeah. So there is a total banking in the ETF.
Banking ETF. It is
Banking
regular, closely matching the banking index.
Correct.
So it is a passive fund, and you are right now launching an active fund.
Yes.
Okay, and then public bank index fund is good for fresh. See, now it is already risen up. What they are asking is PSU fund. Is it good time to enter now, or since they have risen up already? He himself gives the answer also. He is asking where it is good to add now.
So from my fund construction perspective, I'm more constructive on the PSU NBFC space compared to PSU bank space. We do see one or two opportunities in the PSU bank space, but they are so the best part of earnings is probably behind, and we are likely to see some margin pressure coming into CY24. But within PSU NBFC space, I think there is reasonably good value relatively.
Okay, on a relative basis. So
yes,
but on this private banking space is better than PSU banking space.
As of now, yes.
Kind of. Okay. So I think there are either passive. So one investor has come at the time with the DSP Mutual Fund since 2015. So for 7 years, he is investing with your fund house. That is good.
Great. Thank you.
Great. And pretty much, I think that's all from this side, Dhaval. And we wish you good luck on behalf of our subscribers. And
thank you so
thanks
much
for with the new NFO, new fund offer. Thanks for taking time out and on a Saturday on your
absolutely.
Off.
Absolutely, it's been my pleasure. Thank you so much for having me, and thanks for the viewers for watching.
Sure. The video will be automatically get uploaded in YouTube live stream section, so people can watch it. Thank you very much, and have a good day. See you some other time.
Bye.
Bye.